let's kick off the introductions. I want to, we can start it off ladies first. I'd love to have Megan from Seed Invest share a little bit more about yourself. You can give, go into your background a little bit, and then obviously share what you're doing now with Seed Invest and the investments that you guys are making there.
Thanks, Michael. Yeah, absolutely. So I am probably the newest person to this space on this panel. I have been investing at the early stage for the last year and a half. Before that, it was a very circuitous track, I did not see it coming. If you had told me 5 years ago I'd be in VC, I wouldn't have ever guessed it. But I spent the first 6 years of my career in investment banking at Wells Fargo, but I was in a pretty niche group building innovative products that the different product and service and region teams could test out and see if they worked. And so we were basically loss leaders, built something up until it was profitable, and then spun it out to those regions, which was pretty cool. Didn't know what I was going to do after that. Quit, spent some time in South America, as one does when you're lost and trying to come up with your brilliant idea. Did not come up with my brilliant idea hiking in the Andes, but got some great advice that what you spend doing your free time is probably something you should look at for a career. And I kept building business models for friends, helping solo entrepreneurs find co-founders, build out their go-to-market strategy. Didn't really realize that was the startup ecosystem, but kind of fell into it. Ended up getting my MBA at Yale and then joining Seed Invest about a year and a half ago. I was really attracted to the mission. They're really trying to democratize access to the asset class, allowing normal people who are non-accredited investors to invest, and then also allowing accredited investors that might be angels or not associated with institutions, non-professional at the least, to get access to great deal flow. So that's what I have been doing. We're mostly generalist, international, focused mostly on the seed stage, some pre-seed, some Series A.
Fantastic. Thanks so much for being here, Megan. Really appreciate it. And I think we'll definitely get into the whole crowdfunding, AngelList, rolling funds, syndicate, accelerator kind of question here too later on for sure, because I think there's a lot of stuff changing in the early stage game that people should be aware of, different strategies and stuff. But Charlie, do you want to introduce yourself next? I think it'd be great to hear a little bit about your background and everything you're doing now as well.
Yeah, sure. So Charlie O Donnell, Brooklyn Bridge Ventures. I've been in venture a long time now. I joined the asset class in February of 2001. I went from an institutional investor in venture funds to joining Union Square Ventures as its first analyst back in 2005. I joined First Round Capital as a principal in 2009 and helped them open up their New York office. And then started my own firm in 2012. Generally do about 8 or 9 deals a year, New York City area, across a wide variety of industries, generally pre-seed or seed. My rule is if the company has already raised $750K in a previous round, it's too late. So I don't care if you're raising $500K or $3 million. Like, as long as that's the first money, basically the first money to go into the company, I'm happy to take a lead or a co-lead. Or if other VCs want to do the work, that's cool too. But like, VCs usually don't fall over themselves to do a lot of work. So I wind up leading or co-leading most of the deals that I'm in.
Fantastic. And yeah, super glad to have you here as well. And I think that strategy is very interesting. And I think, we can dive into that. I think there's so much, like I said, change with the early stage game that I want to dive into for sure. Danny, why don't you share a little bit more about yourself next?
Yeah, for sure. Hey, everyone. My name is Danny Brown. I'm a partner over at Mac Venture Capital and chief of staff also over at Atom Factory. Basically, we are over at Mac, an early stage fund, pre-seed, seed stage, formed at the top of 2019 as a result of a merger between Cross Culture Ventures, where I've been at for the last 4 years, and then M Ventures, who we had been essentially kind of co-investing and working alongside with. The fund basically is focused on, investing in the thesis that we call cultural investing. So very much so about identifying, entrepreneurs and ideas that are leveraging those large scale shifts in consumer behavior that are tied to social progress trends. Very much so, everything from minority becomes a majority to gender parity to socioeconomic rebalancing, but also factoring in macroeconomic shifts like conscious consumerism, data privacy concerns, COVID, and how that impacted everything. Very much so about democratizing access across every vertical, as we are also vertical agnostic. I ended up getting into venture originally over at Atom Factory. I actually kind of fell into it after undergrad. I had actually been the perpetual intern over at Atom Factory, which is a music management company turned angel fund, where we've made about 100 investments over the last 10 years in a lot of really awesome marquee startups that cover all the different sectors. Help them form, the original Smash Labs accelerator to eventually building out and tracking and essentially, giving the infrastructure to the platform itself. And Troy, who is the CEO of Atom Factory, co-founded Cross Culture with Marlon, who was fresh out of Intel at the time, had previously helped launch their diversity fund and very much so was looking for ways to kind of change the narrative in venture and just create access to opportunity for all demographics that have traditionally been overlooked in the industry. So had been, working along there. And then as we were coming up for the next fundraise, we went into the merger and I helped with the, kind of transition everything over and joined on as partner. And we've been loving it since.
That's awesome. Yeah, really appreciate you being here, Danny. I think you definitely bring an interesting perspective to the panel. So really glad you're a part of this for sure. And last but not least, Gyan, do you want to share more about yourself and your background and everything?
Sure. So I run a $30 million fund that's focused on pre-seed and seed B2B software. And we only really do B2B, so I know nothing of real value in B2C. I started kind of in finance, actually in proprietary investing, ran a business that had about $100 million of revenue by the time I left at a fairly young age, started making angel investments. Went to work for one venture fund, then tried to raise my own venture fund and kind of failed forward and ended up merging with another fund, which is called RTP Seed Ventures. So now we have a $30 million fund. We're relatively location agnostic in the United States. We've done investments in New York, Los Angeles, Wisconsin, Atlanta, and it's exciting to kind of be doing venture in this COVID world. It definitely changes the dynamics a lot in terms of networking and sourcing deals and stuff like that. So I'm enjoying the time.
Well, really appreciate you being here. And yeah, I think we'll definitely dive a little bit into the differences between, B2B and B2C companies, I think as well. I think that will be an interesting discussion as well. But I want to kick things off actually from a topic that Charlie brought up before we were talking, and it kind of goes hand in hand with another thing that he's doing with his firm, and it's this thing called feedback.vc. It's a website, but you can get kind of candid feedback from investors. And one of the things that we were talking about on there was that how do you create a business that is exciting for investors to get behind, right? And Danny, we were talking about too how most funds, pretty much every fund, is looking, when they're making investments, they're looking at that single company if they can return the fund, right? They're really looking for home runs, and because that's how most of the time it works when there's exits and all of that. They're looking for the one or two companies that can 100 or 1000x and bring that return. So I'm curious if you guys have any thoughts around ways entrepreneurs can really show how big their company can be. If you have advice on how to get investors excited about what they're doing, even if it's not necessarily a super exciting industry or something like that, or ways that they can tell their story better that can show how big of a company it can be. And I'm not sure whoever wants to kind of start or if anyone has any thoughts around that, but I think it's a really important thing for founders to really understand is I need to make sure that who the investors that I'm talking to understand that this can be a very large company. I need to tell the story in that way.
Yeah, I'll jump in. So I think there's a couple of things that go into that. First of all, I think the founders that have the most success in the fundraising process are not ones that are asking VCs whether or not the idea is good. They're telling VCs and they know this because they've done the homework, right? So I tend to group founders into 3 groups, right? The first split is smart and not smart. Well, you don't want to back anybody who's not smart, right? So that's an easy one, right? But within the category of smart founders, there's people who've done their homework and people who haven't. And I would say the number one reason why, kind of someone like fails in terms of, not being convincing is because they just didn't go deep enough in their space. Like, so for example, you're pitching and I say, well, isn't this like what such and such other company is doing? And I kind of expect you to know those other companies. I kind of expected you to have used that software, right? And to not be dismissive of, like, actually today I was talking to a company that, has a competitor that's not even a competitor that I'm necessarily that worried about. But last I saw, it was like a $60 million business. And so don't tell me that, like, yeah, customers hate that. Well, no, $60 million of customers pay for that thing, right? So a lot of it is really speaking from a position of confidence because you've done the work. And I think that's a big, big part of it.
Can I jump on that? I think that's so right, because you want these CEOs to paint the vision of the future. And we as investors probably have some sort of bias because we've seen a company in the space before. We know one of your competitors, someone's painted this business model to us before. So that's the bias that's already in our heads going into this. And so you need to be able to correct that and say why our assumptions might be wrong, or say something that's like, here, let me tell you what this possibility could be if you happen to be wrong, or our competitor happens to be wrong, and just really double down on that how and why you're going to get there. All the time I see founders come in and they're like, exactly what Charlie just said, very dismissive of the competition, or like, yeah, I worked in this space for a long time. It's not the right solution. But I don't understand that. I haven't been living that life to understand why it's not the right solution. So conviction.
Yeah, I mean, I'll just going back to kind of the original question a little bit. There's basic analysis that most funds will ask you to do, which is like a bottoms-up TAM, or bottoms-up total addressable market, which is basically saying, like, this is the number of customers that exist in the world, and this is the number in the US, and this is the amount we can charge them. If that market isn't big, if that market's big, it's pretty easy. And if you can make a compelling reason for why that market is big, it's easy. If that market isn't big enough, I think the best suggestion I can give is at least talk about how much value you're creating in the world and the natural adjacencies and how you're going to be able to exploit them in the future. That tends to be harder to do, but if you're a great storyteller and really a pitch deck is a story and a startup is kind of like, or the blueprint to the story of the startup, you can kind of convince people that maybe you can exploit some of those natural adjacencies. And there are many businesses that have done that historically. So I think the trick is really to know where you fall, whether you fall in this space where your market size from kind of a bottoms up financial analyst perspective is too small, or if it's already big enough. And if you fall in the area where it's too small, you have to give a really compelling story for how you expand it, probably by telling people how you create a lot of value for society and how it's so natural to expand it as a result.
Yeah, I just want to double click. I feel like I've had a lot of conversations recently around how important the narrative is, particularly at the early stage. I mean, realistically speaking, us as investors at this point, we're looking for two different things, right? That those founders really are those well-rounded individuals who can tackle these, this specific challenge, and they're dedicated and committed to it. And if for some reason, they're, not 100% capable or something like that, they're at least aware enough to be able to surround themselves with the resources or solutions, or position themselves to find those solutions. But at the same time, kind of explain that, what is that value? What is that awareness of what's going on? Why is this the future? But I think a lot of things get caught up in trying to relay the specifics behind, these are the numbers, these are, our qualifications, these are whatever. But it's like, if you can contextualize everything in a way that's just very much so, look, we're at the onset of, entering this market, or this is a new market in and of itself that is yet to grow and expand, and this is how we can contribute to it. That's very much so something that will get an investor bought in, and kind of, to Megan's point, help unclick us from our biases that we've already come in with. Yeah.
One thing I'll actually add to, one of the hardest things to do is to figure out which narrative works for your particular company. And this is why a lot of these panels, like sometimes you walk out and you're just like, okay, this is the third investor panel I've been to this week, and this is the third different thing that I was told. And the reality with a lot of this stuff is it kind of depends, right? Is it like, there are some businesses where I call them spreadsheet businesses, where it's super clear what you do. It's super clear the customer needs this thing. And really you can just put this whole thing down on paper and just be like, oh, I get it. Every time you hire a salesperson, they sell this much. And then all you need is this amount of dollars. And it's just very straightforward, right? That's very different than saying, I have this new AI, assistant or whatever, in which case it's like, well, depending on what they did for me, I might pay them a ton, but I'd have to understand how good it was, right? Like, and so the pitch for that company is very different than the pitch for something that is like super clear. And I think it's in some ways like building a product where like, you're just gonna have to iterate, right? You should talk to some people, talk to some other founders, talk to some angels or whatever. What clicks, what resonates, what, and especially people who will tell you no, right? Who will basically be like, yeah, that's a terrible idea. You shouldn't do that. Well, why? Like, why wouldn't you buy this thing? Too many founders get happy ears. They talk to friends. They're like, oh yeah, everybody thinks this is an awesome idea. I was like, yeah, they want to be supportive of you because you seem like a nice person, but they're not that excited about this.
Yeah, I totally agree with that. And I think that's one of the reasons why I think the feedback tool that you guys have is super interesting, because it's real feedback. And that's the biggest thing for us. Like as we've been building and, rolling out our app and everything, like I want the real feedback. I'm like, well, why aren't you using it, or what's wrong with it, or, so that we can continue to improve it. And I think that's so critical, is actually finding the people in your life or around you, or, networking to find people who will actually just give you real feedback, so that you can make real adjustments. And I think that's really key. Another thing that you guys said that I want to hint on too is making sure that you're actually paying attention and understanding like your whole competitive landscape. Like I am using all of our competitors and checking out everything that they're doing constantly, just because there might be something that is super interesting that I'm like, okay, well, we actually could probably integrate this in, or use that, or tweak this to have it make sense. So I think that's another really a really key thing. I don't know if anyone else wants to add into any of this, but I want to jump into the next topic if everyone is good on that. But I think it was fantastic advice for sure.
Jump in, move forward, steamroll.
Okay. So the next thing I want to get into is kind of this, I mentioned it earlier, but kind of the whole dynamic that's changing with early stage investing. For founders, there's so many different options now and routes to go in the early stages. Leading into the last kind of topic is like, when do you need to raise funds, right? Because a lot of founders, they think they need to raise money and raise capital right away. But, I'm more of a believer in really kind of getting traction and getting money from your customers or figuring out other ways to do it. Obviously, every business is different. It depends on what you're doing, but there's a lot of different strategies as far as applying to accelerators or doing an angel syndicate or doing equity crowdfunding on a platform like Seed Invest, like Megan. So I'm curious your thoughts around these different alternatives and opportunities for founders at the earlier stages. And if you have any advice or tips on how people should go about doing those, if anyone wants to jump in on that, I'd love to hear your thoughts on it.
Sure, I'll jump in. I was giving everybody the pause. I didn't want to, I was happy to have you guys come before me, but so look, the reality of most startup businesses is that they don't necessarily raise venture. I just want to ask you a quick question. Am I the only one that I'm only looking at Danny on the screen? Maybe it's just me.
We can see you.
You can. Yeah, we can see you. You could
All right.
change to. It's probably in speaker view. You could change the gallery if you want. But yeah.
No, for some reason when I was talking, it just throws Danny's face up there, and he's ignoring the eye. I was just like, I wonder. That's sort of a weird thing.
Danny hacked it so that when you talk, it's his face showing up the whole time.
All that wisdom just stamped my face right on.
It's totally fine. It's inspiring, frankly. So look, the reality is most businesses don't take outside capital, right? And that's, when we talk about like most businesses, we talk about everything from like, the restaurant down the street to, the real estate firm or what have you, right? Why would you take outside capital? You take outside capital if it enables you to make a leap in your business, right? There are some businesses that are better if they can grow either for one of two reasons, right? Either you can't build the product that you want to sell customers without it, right? It's just that like there is no bootstrapped version of a certain thing. Like there's a bootstrapped version of a consulting business. It's just you and a business card. And like, that's basically it, right? There's no bootstrapped version of trying to build a time machine, right? There's no like, either you hire a bunch of expensive physicists or you don't. And so some people don't have a choice. Now there's some people who are able to get in versions of their business. And this is where I think it gets tricky. I was just on the phone before with a founder who built a version of her business that I'm not sure proved what she was trying to prove. And it actually, I think, in some ways made the business worse because it wasn't a great version of her product. And she was out there doing this pitch that was like, people really love this. But the revenues weren't quite there. I think it was kind of expensive for what she was offering. And like, for a bootstrapped company, it was great. But I actually think she would have been better off just raising money from the beginning, building the product that she really wanted to put out there at the price point she wanted to put out there, because bootstrapping didn't give her any credit with investors. It was almost a distraction. I was like, why? This business has been around for a year. Like, why doesn't it have more revenues? I would have almost rather bet on the PowerPoint with no revenues.
I think that there's a lot to be said about discipline for founders. it's one of my favorite, I think that was one of your questions, is founder characteristics. I love it when someone can tell me exactly what their burn is going to be for the next 12 months and how much money they need to get there. So I think there's a lot to be said about founders being disciplined. That being said, there's definitely a gap in funding. And so sometimes you can't just like start out month one, go out to institutional investors. So know who your customer is and try to get some really great strategic angels. If your end customer is Microsoft, talk to every single, there's, I don't know, like 200,000 people that work for Microsoft. It's a huge company. Get some people at Microsoft to be strategic angels, to put in some capital to back you. So don't just jump. I think people think of this like VC storybook narrative of like, I have to raise money, let's do it. Try to get angels that believe and work in the industry that you're going after to invest, like even small checks. Try to get them on board and be advisors, and then they can help you close some of those first customers and get you to the point where you need to be to raise the more institutional capital.
You know, to that end, there's that saying, you ask for advice and get money, and ask for money and get advice. And I think the other reason why you want to go talk to people who are strategic is that's who I'm going to go talk to, right? Like if you're telling me, yeah, you know, this is going to be the best tool for heads of people, I'm immediately going to go ask a bunch of heads of people, right? Because I'm not that person. So it would be better, for example, like when I backed Clubhouse Software, the product management tool, not the other thing.
I was just going to say, are you talking about the
yeah, no,
audio?
not the cesspool. The product management software, one of my CTOs that I had backed put 10 grand of angel money into it because he thought it was the best product management software that he had ever built, that he'd ever used, right? So like when a customer will reach into their own pocket and even in a small check, a 5K check, whatever, that's really meaningful.
%. Danny, you have anything to add to that?
No, I think they both hit it on the head, you know. It's that, you know, classic chicken and egg problem. You either are kind of, or here, let me start with this. Founders usually kind of have that kind of, you know, textbook, this is my track on VC and I need to fundraise to build this product, but I don't have this product or the traction or market validation that you as an investor are looking for. How do I begin to do it? And that's usually kind of the flywheel that is probably most aggravating and what most founders ask, particularly in that feedback kind of section. And it really is kind of, you know, to the points that they both brought up. It's, you know, if you can't get people to kind of jump in and either buy your product, believe in the vision and kind of support you, then, you know, it's kind of what we were talking about beforehand, where the company is ranging kind of around a 7, or maybe it's a little bit lower than that, where it's just, if you're caught in that wedge, then, you know, all you can really do is try to start to think outside the box and outside of your specific viewpoint. And it kind of goes back to what you're saying around just knowing how to surround yourself with other people that can help you assess your position and kind of tweak it. Those are, you know, the couple of things I'd have to add, but they said it much better than I did.
One thing I'll add too is it's really important to think of fundraising as selling tickets to the future and not trying to get a reward for the past, because there are a lot of people that have accomplished some really amazing things bootstrapping, and they get frustrated, right? They're like, hey, I'm profitable. Why can't I raise venture money? And it's like, yeah, I mean, that's awesome. That's good for you that your company's not going to go anywhere, but it doesn't prove that you're going to have $200 million of revenue in the future, right? And just because you've gotten to profitability doesn't mean that that is necessarily going to be the case. And I'm interested in the future, right? I mean, what you did previously, that says something, right? Like you get some credit for that. And maybe you did some hard stuff that I wouldn't have thought you'd be able to do, but you should spend 80 to 90% of your time talking about what you're going to do. Like what, you know, you're raising a seed round. Okay, well, where's this going to get you? Like what are your goals for this round? Is that do we think that that could get you a Series A, or, you know, it's forward looking?
I guess the one thing I would add is there are other sources of capital, including bank debt. Now there's even these like SaaS factoring businesses. I don't know how great they are, but like Pipe and a couple others. So if you have a great bootstrap business, I would just suggest that you don't necessarily need to take venture capital, and you should weigh out what you're trying to build and whether it meets kind of the requirements of a venture fund. And there's a ton of articles about that. I think I think Josh Koppelman said like rocket fuel versus motorcycle fuel or something like that. And if it doesn't, there's still lots of other ways to raise capital. And I think a couple are obviously angel investors, if you can find access to them, who sometimes have different kind of capital or return needs, or platforms like Seed Invest or others, or AngelList or bank debt, or these factoring platforms. So you kind of have to think through what really is right for your business and what's right for you and your team. And I wouldn't encourage people to just kind of be stuck on raising venture capital. Such a small proportion of companies raise venture capital, and out of that proportion of companies that raise venture capital, probably less than half of them should have raised it. So just be conscious of that.
Yeah, I think that's a great point. And understanding the type of business that you have is so critical. You mentioned some of the other ones. There's others like ClearBank and stuff too that are basically, you know, seeing the revenues that you have coming in and giving you working capital as well without taking equity, and, you know, really more or less kind of like more so a traditional loan in that sense. So that can be interesting for a lot of companies too. And so you can save your equity and get the capital that you need. I want to bring up, we had a couple questions coming in. One of them, I think it leads really well into this, is what about sole members, like single founders, right? Do you have you guys invested in any sole founders, and or does that change the narrative at all? Would you encourage them to find a co-founder before coming back for capital? And I'm just curious around your thoughts with that, and sole founders versus, you know, how many co-founders should someone have, and is it necessary before approaching investors?
I can go first on this one. So I think Aileen Lee at one point did this study and found that like a large number of the unicorns have like 2 founders. But what she didn't look at is how many companies are just started with 2 founders. So we don't actually have much anecdote, like numbers about success rates of sole founders versus 2 founders versus 3 founders, or anything like that. A lot of funds are more comfortable with multiple founders because it de-risks maybe certain parts of go-to-market, right? You might have a technical person and somebody who's focused on go-to-market or marketing or something like that. I think it really boils down to, does the product and go-to-market you're building require multiple people on the founding team? Potentially you can be so well-rounded that it's not required, or a company could be really focused on one niche that really needs to be de-risked first, like a open source project really needs to build a lot of open source credibility before you go out and do marketing. In those situations, it can be fine. And there have been many great companies that have had a single founder or a founder with overwhelmingly more equity. So I think it really just depends on who you are and the story, the narrative you can weave. I would also just say that even if you have multiple founders, it's normal to have founders with different levels of equity. One person has 80%, another person has 20%. So don't think of it as always as like taking a 50-50 partner. You can try to augment your weaknesses with a co-founder who you treat as a 50-50 partner, but maybe the equity still takes or is cognizant of the risk you took very early on, because it's hard to start a company.
Yeah, I agree. And you started down the direction of something that I think is an important distinction. There's a couple of different ways to slice this. There's who has a co-founder title. There's how much equity does everybody have. and then there's elements of control. And all three of those things might be different, right? Like, are you giving this person a board seat? Like, I had a 50-50 co-founder, and technically, as our company was written, either one of us could fire the other one. I mean, that's really seriously having a co-founder, and you don't write those kinds of rules unless you plan to enforce them. Now, on the other side of the spectrum, I'm in the process of closing on a deal where there are 3 employees at a company. 2 of them have a co-founder title and the other doesn't. And I suggested to the founder, I was like, you know what? I think you should just give that other person a co-founder title, because, and I think that like, it's fine to give them that title even if they only have 1% of the company, because I think, hey, look, this person was here from the beginning and has been underpaid since you started this thing. And it will be really nice for her career going forward, if this is, you know, a success, to just have that extra cachet. But, you know, the reality is that person's not getting a board seat. They're not getting a huge chunk of equity. Their place in the org chart is not changing. And I had a couple of companies like that where they were generous with the title, but there was an org chart reality and an equity reality that was a little different. And it was more just an acknowledgement of the team of like, hey, you're here early. I get that, you know, I'm not paying you a lot and you're important, but that does not necessarily mean you have to give away half your company to everybody.
I'd say personally, I have not invested in any solo founders. Part of my investment thesis is that I want to see at least one full-time employee that's a non-founder, because I mean, I'm investing a little bit later stage seed, because I want to see, can you convince other people to work on this with you? Also, like, people that are doing this kind of part-time and they haven't jumped on to doing it full-time yet, if you're asking for investors' money, I'd like to see you working on it full-time and that you've gotten at least one other person to join you to do it full-time.
I'm going to create some panel controversy. So Megan, I'm a solo founder. I have no other employees. I'd like to raise money at a 5 pre. I'm doing $1 million in free cash flow. You don't want a piece of my company? I don't have any employees yet. I need your help.
There are always exceptions to every rule. I would say for that, you've done this before. Like you're maybe not a first-time founder. You've figured out the industry and you're doing it on your own. But of course, with all rules, they're meant to be broken.
Break the rules, not the law.
Right.
Danny, did you want to add anything to that?
Aside from asking Charlie to send over the link to the data room, I think that's, you know, the only extra add here, and I think we've hit it home, is just that it's really about the fact that being a solo founder is hard, but at the same time, there is the double-edged sword of there can be too many cooks in the kitchen. If a company rolls in with 4 co-founders, I've seen 5, and, you know, honestly, it's probably, you know, those are just co-founders in title, but it's really much so about who is pulling weight and making sure that, you know, everyone is at least, you know, to some degree, a domain expert in what they're tackling at this like critical early stage of the company. And if you as a solo founder are able to, you know, get it up off the ground running and get to the point where you're able to hire on your first teammate or 2, and there's no equity package or something like that because you're a $5 million valuation company pulling in $1 million, you know, then great. But otherwise, it's just really about kind of just finding that cohesive unit of people who believe in this vision and are able to allocate themselves and their resources to like making it happen. But yeah, I think it's more of a bell curve. So I'm looking for that 2 to 3 co-founder spot, but there's no real requirement to it.
I'll just add one thing, like being a solo founder is really hard. Emotionally, right, having a startup is an incredibly wearing process. It's a 10-year to 12-year thing. And especially if you're a solo founder, it can feel fairly lonely. As much as VCs want to say they're aligned with you, there will be times when there aren't. You can have a coach and that'll help, but there's nothing like maybe chatting with a co-founder at some point in time and saying like, hey, what's our strategy? Or when, stuff hits the wall, do we really have this in us? And, pushing each other maybe to make that happen. So another aspect of this is just like thinking through whether you actually want to be a solo founder, if you are, because it is a real journey. And some people want to and will thrive in it, and others probably would be better off giving up some equity and finding someone else to really join them on that journey, some form of partner.
I think that's a really great point. One of the reasons that I started Entre from the beginning was because I was really lonely when I first got into entrepreneurship. None of my friends were entrepreneurs, and when my family was, I was kind of just out there, on the internet trying to figure out how the heck to start a business. And, I used to be a civil engineer, so there wasn't really like, a lot of skill sets that I learned from that. So, and I saw that just being around like-minded people helped so much. And, that's why we do a lot of events. That's why we're building out this whole, network to really like solve, one of the problems is the loneliness issue. The other one is hoping to solve the co-founder issue as well, and helping people find, matching co-founders if they can't out there. So, I think this is fantastic, guys. All of that advice was phenomenal. And I want to, Danny, you brought up something too that I think is important to hint on real quick, is this data room. And how important having your ducks in a row when you are sending VCs documents and stuff like that. Obviously, everyone knows about a pitch deck, but some people might not know what a data room is or what they should put in that. So I'd love for you or maybe some other people to jump in on this too about what that is. What should they have in there? And what things are you looking for when you start talking to, companies that you want to see and have them send over to you?
Yeah, totally. Happy to take a stab at that one, and everyone else feel free to jump in as well. Now, what I'm going to say is, I'm going to list out everything, but obviously with the caveat of at early stage, you might not have all of these things ready, right? Like if you're pre-market, you're not going to have necessarily a full list of who's in your pipeline, who you're in conversations with, things like that, or you might not have, crystal clear projections or financials. But ideally what I'm looking for in a data room is all of the materials that are going to help me go through the diligence process. So yes, the pitch deck, yes, kind of like the overview of what you're doing, but would love things along the lines of, who are your customers that are on your Rolodex so far or on your roster? What's your pipeline? Where are those conversations at? And then what is that, what does the breakdown of your business model look like? If you have actuals, would love to take a look through those. And then, what are those projections going forward? Other things would be, documents related to the deal, if those are already, in process, things like that, just to kind of see what's going on. Those pro formas and the cap table of, prior existing rounds, if you've done a pre-seed, friends and family, things like that, just so that I can do everything from modeling out potential ownership to just getting an understanding of where everything is at, both for myself and also for founders, because I think also, Michael, you touched on, I can't remember who said it specifically, but VCs, we do love to say that we're aligning with you, and we very much so are. But sometimes, what we mean by that is we're looking for making sure that when the company goes and fundraises in the future, that the founders still have some of that equity, right? Like some people take crazy dilution up front when they're still new to the journey and they don't know what they're doing. So it might feel like you're oversharing documents, but as I'm going through, I'm just kind of looking for any little tiny thing that I can sort of spit information out on and really kind of help guide the journey. But yeah, those are kind of the what's and the whys behind it.
Fantastic. I don't know, Charlie, or if anyone else wants to add anything to that, but yeah, I think it's great for people to understand what they should have.
I'm happy to, oh, Charlie, you go ahead. I'm very curious to see what other people ask for, because I've been told I'm a little bit crazy and very New York.
So the thing that you have to realize is that we see a lot of stuff. And so if I can't understand what you're doing, I'm just going to skip to the next thing. And so, and hey, I might miss something, but statistically, I probably won't. So, I think sometimes people kind of fluff up the language and they just try and make things seem more technical or complicated or whatever, when like if you're a company that makes blue boxes and they're the best boxes in the world, just say we make blue boxes. Like, that's okay, great. Like, and then tell me why that's exciting or whatever, but don't attempt to describe a box without using the word box. Like, it's a box. I think the other thing is VCs notoriously have low attention spans. And so it needs a hook, right? In the first couple of pages, I just need to know why I should be excited, like capture my attention. Too often people check this list off of like, okay, well, you know, we need a team page, we need a competition page, we need all this other stuff. If team is not the reason why I'm investing, you know, like maybe you built a cool app that there's a lot of usage, but your team is like, I mean, you're all very nice people, but you're not on paper particularly interesting. Why is the team page up front? Just be like, hey, yeah, we're a bunch of hackers who happen to build something that 1 million people like so far. Like, throw the team slide at the end, or maybe not even have a team slide. Just show me that just graph of like, oh my God, the usage is off the chart. Now I know why I'm talking to you, right? So like, know what that hook is from the beginning, and just imagine my attention span. The other thing is to, it's a marketing presentation. It's not an objective accounting of everything that has gone on. And so I'll never forget, a company that I backed showed me a slide of their addressable market. And they do software for oncology clinics, which is like, I forget, it's like a $2 or $3 billion market. And tech that goes into oncology is like a $15 billion market. So they showed the whole pie that was basically gray, and their little sliver was blue. And it's like, this is our market. And I'm like, that's the worst presentation of a $2 billion market that I have ever seen. It was this tiny little slice of the pie. I'm like, why did you do it that way, right? So just tell me, like, yeah, it's a really big market. I don't care about the $13 billion that isn't your market. I care about the $2 billion that is your market. So it's a marketing presentation. So show it to, you know, show it to people who are graphic designers, show it to people who are marketers, like ask them if it jumps off the page. And I do think it is worth the couple of $100 to get a professional to like design it. If you really believe you have something that is fundable, looking professional, the small investment that it takes to do that, I actually think it's worthwhile. I think it just shows that if you can get it done on the cheap, I think there's something to that.
I think it shows that you care a lot about it too, which I think in turn makes the VCs at least appreciate it and willing to go through it if it looks very well done and very professional. Same thing with the website, right? Like if I'm going on someone's site and it's like old school, like whatever, I'm like, yo.
Unless you have the metrics to back it up,
well,
right?
Of course, yeah. I mean, that's also true.
Like our site sucks. Like in this process, the company I was talking about before with the 3 co-founders, their site's awful, but they just signed they're in the process of signing $250,000 worth of contracts. And actually did kind of hurt them, because one of the VCs that wound up passing sent the site to a couple of potential clients, and they were like, I don't get this. And they're like, right, we haven't gotten to the site yet. It doesn't have our updated language.
Yeah.
And it actually cost them on the fundraising, because they had something up, but they're too busy making money to worry about it.
Yeah, I think websites are so easy to redesign now, though, and look at least decent, that it shouldn't be that big of an issue. But yeah, I don't know, Megan, if you have, I saw you drop some thoughts into the chat, so I'd love to have you share your thoughts on it too.
Yeah, I would just say I shared everything that I asked for in the chat. It's a lot, but I'd say in general, help me do my job and tell me what's like, don't hide the elephant in the room, like deep down in the cap table. Turns out you gave away 50% of your business and now they're no longer in the company. Or you pivoted 2 years ago and all of your customers churned. Like, don't make me have to dig in and find all of that. If I do, I'm already kind of like, is there some dishonesty here? Like, why didn't they just tell me this up front? Every company is filled with failures and pivots. Like, I feel like a early stage pitch deck is like asking a college freshman what they're going to major in. Like, sure you are. Like, that's what you're going to do with your life. Let's talk to me again in 5 years. So just tell me what I'm going to find in this analysis and be like, hey, this didn't work out. We tried this, or like, there's this little red flag. We're working on it. Just don't have me like dig through and spend hours on this and then be like, man, why didn't you tell me?
Yeah, I
Yeah.
think a lot of people treat talking to investors kind of like going to the principal's office. You're sort of like, oh no, like I'm trying to like lower the blame or trying to, draw sight away from all of those crazy red flags, big elephants, whatever you want to call them. But realistically, I mean, it's just context. Like at the end of the day, it's like we're gonna find those things one way or the other. So like take the opportunity first, go on the offensive and explain to us why those situations happened, what you did to resolve them, or if this is sort of a one-off thing. You could have a seasonal business and we might not have realized that. If you don't tell us that, we're not going to know it. It's little tiny things like that that just go the long way in helping us form our own opinions and kind of cluing in the rest of our investment team or our investment committees, whatever, in order to smooth over or at least solidly make those decisions ourselves. And it's really just so that, we know how best to help you, because obviously we know at the early stage, you're not a perfect company yet. If that was the case, you wouldn't need to probably be raising money in the first place.
One other comment I'll make too is people's relationships with projections is definitely like not the same across the board. And VCs want to see what's possible, not what's probable. We know that it's not probable. We know that probably you're going to go out of business, right? That's not what you're showing. And I think a lot of founders sink their own pitch by showing projections and expectations that are far too conservative because they think that it's a promise. And I think it's in my experience, I don't want to generalize. In my experience, it has generally more often been the case for female founders and founders of color who I can't tell you how many times where somebody has projected a business that does not get to $100 million in revenues, where I turn the tables on them and I say, is it possible that this business drives over $100 million in revenue? And that is the most confident moment in their entire pitch deck. And they're like, oh yeah, of course. And I was like, yeah, but why didn't you say that? Like you literally are telling me. And they're like, well, yeah, but for that to happen, this has to happen and this happen and this has to happen. Well, yeah, but you're trying to make all of those things happen. I know they're not all going to happen the way you think, but you're also not going to get in trouble if it doesn't, despite your best efforts and your hard work. So when you have a bunch of VCs who could invest in any particular company, and somebody comes in and says, yeah, I got a sure shot of making this a $30 million business, and somebody else says, I have a sure shot of making this a $100 million business, frankly, like it's not really our job, although I think a good VC turns around and pushes a little bit if they think an idea is interesting, but it's not our job to pitch your company to ourselves, right? Like if you come in and say, hey, I think this is a $30 million outcome or $30 million in revs, then like most people are going to be like, okay, well, that's just not what I'm looking for. And you could be just as confident in your business as, the straight white dude who came in before, who's, telling you exactly what's going to happen as if it's, set in stone. But meanwhile, 19 totally improbable things have to happen to make that work. But he's in there saying it's going to happen, So it's always about what's possible and the assumption of success. And then we all know as soon as we write the check, then we plan and we make the real budget for what we expect to actually happen afterwards.
No, I think that's a big, big thing. And I'm really glad you touched on it, Charlie. I think, this couldn't have been said much better, but just the things to add is that it really is that point of confidence and to drive it home. And I think especially, I'd be remiss if I didn't just chime in, especially for founders of color, female founders, sexual, religious, minority founders, there is that kind of tendency to sort of lowball those projections. And I think, obviously that's the mindset of wanting to be perceived as a slightly more safe investment, right? Like we know the statistics, we know that it's a way more of an uphill battle for those founders. But that being said, we also have that data that shows that those founders create outside returns far more than, any other groups. The fact of the matter is that like you really have to lean in and sell us on that vision and sell us on that buy-in, because no matter how much we're saying we're signing up for this journey, we as investors are still, regardless of however long it takes us to get there, focused on the exit. And that's going to be based on your projections and your performance. We are going to, whatever you give us, dial it down and sensitize it just to make a worst case scenario for us. So don't make that so much more easier for us. Like, tell us why you're going to be a unicorn, or why not, and what are those deltas and how we're going to go overcome them so that we can get you to that status and have the exit we all want, deserve, feel good, all that stuff. But yeah.
Fantastic. Well, that was amazing. I wasn't expecting to get that into detail about Data Room, but you guys all made fantastic points there. And I think it's super important. One thing that I just want to, kind of summarize about being really transparent, just as much as, founders should want investors to be transparent if they, with feedback or whether they think it's a good idea or a bad idea, whatever, upfront. I think it's important that founders be transparent with investors and not try to hide things or wait till last minute to tell them, something that's messed up with their co-founder, or a customer that, makes up 60% of their revenue or something is leaving, or, those sorts of things. But, yeah, thank you so much for sharing all of that. We'll kind of wrap up with, I have one kind of question, and then we'll get into some Q&A. So if you have questions, shoot it in the chat, or, you can message me directly if you have questions, and we'll do a Q&A at the end. And then we might do a breakout session too for those of you who want to network, depending on how many people are sticking on till the end. But the last thing I want to get into is really around this whole, as I've been learning more about all of this stuff and interviewing investors and founders and stuff, one of the biggest things that keeps coming up is product market fit. And I want to touch on this because I never really realized how important it was until I started really diving deep into like what it actually means. So I'd love to get your guys' thoughts on that. And I know most of you, like you're kind of at the earlier stages where you're working with a lot of companies that are figuring this out. And I'm sure you're trying to help to get them to product market fit, so they just hit that inflection point and just start soaring into Series A and beyond. So I'm not sure whoever has thoughts on this, or if anyone has advice on how founders can really dial into this product market fit and strategies for understanding their customers and figuring out ways to get to that as fast as possible.
I guess maybe let's start by defining product market fit, and we can go from there.
Great idea.
And this is going to be a weird definition, but I guess the definition that I've heard is like when you have product market fit, you'll know it because basically you have no time to build new product because customers are kind of like throwing themselves at you, and you are too busy servicing customers and selling customers to even kind of be worrying about everything. And you almost end up sitting there and like being focused on just like reliability or resilience engineering because your product is like going down because there's so much demand. That almost never happens, to be clear. There's a few examples of that, like one of my colleagues in my fund invested in Datadog, and there's a point when I think they probably felt like they had product market fit in a real way, or Facebook. But for the most part, I think you're constantly iterating on trying to, whether if you're in B2B, getting feedback from your customers to try to iterate on the product and edit it and change it. If you're consumer, you can maybe use some statistical methods, A/B testing, etc., to have a pretty good idea of what's working or what's not working. But you're constantly iterating on that stuff. And the answer to me is a mixture of talk to customers and get feedback from customers, and then also have a vision for what your product is going to be. Because if you constantly kind of iterate on the micro customer feedback that you get, you might you might hit like a local optimum instead of the long-term optimum. So talk to customers and then have a vision, and hopefully the combination of the two gets you to where you need to be.
Please talk to customers. Always talk to customers.
Yeah, I think that a lot of times what happens is founders wind up on my doorstep because they've allocated a certain amount of developer time or friends and family money or personal capital to build a thing, and they didn't allocate enough time to iterate on it. And so they come in and they say, here's a thing I got built, and the engagement numbers, the usage numbers are just not great. And they are convinced they know the problem as to why, but they don't have the money to fix it. And that's just a very difficult pitch, because it means two things. It's like, one, well, you could be wrong, but also the only data point I have is that you misallocated your budget to spend all of it on V1 and not leave, like, so like the only data point is that you overused your budget, right? You use your budget kind of poorly, as opposed to saying, hey, I got, $100 to build something. I'm going to spend 10 to get, to essentially buy information, to buy understanding about my customer, and then spend the other $90 sort of iterating over time, so that by the time I really need money, I'm where I need to be in terms of engagement.
One thing there is, I think the positive for many of the founders here is that despite how difficult it is to raise money right now, it's never probably been easier as well in terms of the venture markets. There's just so much money out there. But I do think you need to remember that this is effectively like a momentum business, and venture investors are looking for momentum of some sort. So you don't want to come in at like this kind of low momentum moment where you might have a thesis. You're much better off coming in at times when you have some momentum, even if they're not the full gamut of product market fit. Because I just think venture investors are probably not as kind of thoughtful and intelligent as they used to be. And also they may not have as much time to kind of do all the digging. So even if you can't get the full product market fit, the one thing I would counsel startups to do is just constantly make sure you're making progress. And ideally, when you're going out to raise, make sure you're making like relatively rapid progress that makes people think you're at an inflection point, because it'll just make your life a lot easier. So that would be my thoughts for you guys.
One thing I want to see too is a real deep understanding of the problem. So product market fit to me is a term always focused too much on product. And product's going to change, it's going to iterate, you're going to add stuff over time. But if I have a really in-depth conversation with a founder about what problem they're trying to solve and how they're going about it, that's so much more confidence inducing than if you like wow me with a bunch of features. Like, let me demo all of this stuff. It's like, well, I'm probably not the target consumer most of the time. But if you tell me, hey, here's what people experience when they're a buyer of X or when they are a user of X, and here's how we're going to solve that. I think that's more meaningful, right? I mean, if you imagine, like, let's say you took the original pitch for Tinder, which is not really a thing because it was developed in IAC, but let's imagine it. Somebody came to you and showed you swiping. You might be like, well, that's cool, I guess. Like, it's interesting, but it would be a much more convincing pitch to say, hey, listen, everybody else in the market tries to make a really good match. And so the extreme of that is eHarmony that makes you fill out 1,000 questions to get to the one person on the face of the earth you're trying to match with, right? We're going the other way. We think it's impossible to figure out who matches with who, so we just want to try and get them talking as quickly as possible. And so, like, oh, that's a really interesting conception of the problem. And that would give me some confidence that if, like, that's the angle they're trying to solve, that gives me much better context than just showing me swiping, which, like, I don't know why you built swiping unless you show me your understanding of the problem.
Yeah, I think that's really interesting. And I'm glad you brought that up for sure. I think at the core, it is like solving the problem and understanding that problem on a deep level and getting to that is really critical. We had a question earlier around, I know I brought it up, but I don't think we got into it that deep, which is around crowdfunding versus the more traditional, just, private rounds, right? With angels or VCs. Obviously it depends on your business. We're actually going to be announcing something here shortly with one of our partners, with an equity crowdfunding round on WeFunder actually. And it was a great fit for our business because we believe it will not only allow us to raise capital, but also serve as a marketing and user acquisition channel for us, because a lot of the people that are going to be on these platforms are also some of our ideal users. So it's worked out really well. And, I think depending on the type of business that someone has, it could be an even better opportunity than going the more traditional route. Although, and I'd like to get your guys' take on this too, but, a lot of investors seem to be warming up a little bit more to the idea, although I know a lot of traditional VCs don't really like to see crowdfunding, at early stages. But I'd love to hear your guys' thoughts on that. I don't know, Megan, if you want to kick it off since you're in the space, as well. So it'd be interesting to get everyone else's thoughts on it as well.
Yeah, I don't think of it as an either or. I don't think it should be a fundraising type of last resort. It is a great complement to filling around for exactly the reason you laid out. If it is acquiring users, if you have a really engaged community. I just worked on an amazing fundraise with a founder who has over 100,000 users that love it and are like brand evangelists, constantly tweeting about it. And now they're investors. They own like 0.0001% of the business, but now they're getting all of their friends to join. But that was a compliment to a round that was led by Andreessen Horowitz. So like that, it was just one part of the thing. It's not the whole thing. So I think there are some traps to avoid. Like I wouldn't crowdfund because you're trying to raise on egregious terms and nobody will take your $20 million valuation cap that you can't get anywhere else. I think it should usually be a small part of a fundraise to get you to the next step. If you're like, you know, you need that last 250,000 or 500,000 of a $2 or $3 million round, and you want to spread the word about what you've built and acquire customers that way and market your company, I think it's a great thing to do.
Yeah, I think the whole VCs don't like X is mostly bullshit when you hear it. Look, VCs by percentage don't like most companies, right? Like I see 2,000 things in a year and I only invest in 8 of them. So, you know, I could say that for any number of different types of things. I was in a company where we thought about doing it, and a bunch of the investors who are actually, I find it's more of an issue for non-traditional investors who imagine, I don't know, that it looks like, well, you couldn't get investment from real investors or whoever. It's like, money's money. Like, and I basically said, like, are you guys writing the check? No? Then shut the fuck up, right? Like, that's basically my approach to it. Like, this company needs money. If this is a plan to get money that is painless and, you know, has a higher guarantee of closing than randomly going out to whoever, then like, let's do it. Let's keep all the options sort of on the table. Especially for companies that have engaged, you know, fan bases and stuff. I think that's fine. I do think there are a lot of, you know, Gyan said something before, which I think is true, but it's sort of unfortunate, is that like, there's a lot more people in VC than there used to be. And the experience level of your average person in VC is lower than it was before. I won't say that they're not as smart as they will, which is maybe I think what he might have said, but like there's just less VCs out there that you'll encounter that have seen multiple cycles, that have really taken serious risk on something. And so I do think there's a reality of certain things that signal for potential weakness or whatever, that you might get feedback from somebody that, you know, like if, like, I think your average analyst or, you know, principal or whatever, who's newer to the industry finds it hard to believe that there's awesome stuff on a crowdfunding platform. But the reality is, there is no magical deal flow stream or place where you can go where like all the good companies are hanging out. Like lots of Y Combinator companies fail too, right? And so it's all about finding those, you know, diamonds in the rough and all of that sort of stuff. So like, yeah, I wouldn't be surprised if companies heard that, but really good VCs will look past screwy cap tables with, I mean, Petal, the credit card company that just announced its Series C, had 23 people on the cap table. The seed round, which I led, we would have taken anybody, frankly. I mean, we had a lot of trouble closing that seed round. So the idea that like only the best VCs go into the best companies is like early on is just not the case.
Thanks for sharing that. Yeah, I think that was great. I don't know if Danny or Gyan, you want to add anything to that?
I think Megan might have a comment.
I was just going to say, I totally agree with what Charlie's saying. And the real gap that I'm finding that it's filling is for those women or people of color that VCs say, hey, go out, raise a friends and family round, and then come back to me, that don't have these deep networks of people they can call and raise $1 million very quickly. So it's like, I still want to see a signal. Do you have strategic investors, people that believe in this? You've gotten most of the way there, kind of what Charlie's probably saying about this company Petal, but you just need to fill in the rest of this round to take that cash and get moving and lead your full-time job as CEO of this company and stop fundraising. That's really the spot that I think it's really good for.
For sure. And I look at it as I would much rather take $500,000 from our users and our network than random early stage VC, not necessarily random early stage VCs, but then a few early stage VCs. If we can get, our users to also be owners, it's, it's going to change the game, because they're going to share it and feel like they're a part of it much, much more. But we're using this as a catalyst to catapult us also into another round right afterwards. We want to, show massive growth during these next few months as this is all going on, and really just prove out everything that we're doing even way more. So, yeah, thank you for your thoughts on all that. I don't want to keep everyone, too much longer. I'd like to wrap up if everyone can, just share any final pieces of advice for founders, and where can people find out more about you, your firm? Where should they reach out if they might have an interesting business, whether it's Twitter, or LinkedIn, or whatever, if you're on Clubhouse, Charlie. Yeah, where should people find you, and any final piece of advice, whoever wants to go first?
I could go first, but I was also just typing my contact information into the little chat here, but I'll do that after. So yeah, I think like for me, it's never too early to reach out, as long as you're a New York City based business that hasn't yet raised 750K. And I would say, don't make assumptions about what VCs look for, what the way you're supposed to do things are. I think there's just like a lot of like reasonable person standard stuff that you can apply. And I would say it's okay just not to know certain things, right? To say, hey, I have this interesting thing. It's gotten some traction. I really don't know how much bigger it can get. And I'm looking for a next step. I mean, I think that's fine too. I think there are a lot of instances where founders have approached VCs early. The right VCs will roll up sleeves a little bit and won't be afraid to do a little work for an interesting problem.
My contact info is in the chat as well. I think that makes sense. I guess my closing thoughts would be that running a startup is really hard. So kudos to everyone who's starting their own companies. We appreciate you. We wouldn't exist without you. But I think the biggest thing you can do as a founder is keep yourself mentally and emotionally healthy. And it's really hard to do. So just please focus on that as well.
Yeah, I'm going to double down on the definitely take care of yourselves. This is a crazy kind of market climate. It's, an interesting time for all of us on both sides of the table to be going out fundraising, navigating, our deal flow and how to, really tackle the whole portfolio construction and, sensitizing things here. But there's a real toll, and we're all, more or less trapped inside. So try and find an activity to get outdoors and, really kind of rebalance. But definitely feel free to reach out. I dropped my email and my LinkedIn as well. Our website, macventurecapital.com, also has all of our like aggregated news on us and our portfolio, as well as a contact form as well. But yeah, feel free to reach out on any of those.
I also dropped my chat on the side. I'd say my kind of hot tip would be when you're reaching out on Twitter, on LinkedIn, by email, give a little bit of blurb about the company and the context and what you're looking for. If you're looking for a connection, if you're looking for funding, put it all there. It's amazing when I see like a whole little bulleted little thing, like here's our traction, here's my email, here's what I'm asking for, here's who I can connect with, and you can forward this blurb to whoever you want. Make it super easy. I think it's really hard when we get a lot of LinkedIn or emails that say, hey, do you have time to connect? Do you have time to jump on the phone? It's like, I don't know. I really don't have a whole lot of time to connect. Like what can I help you with? And I might be able to get there more quickly.
Yeah, I think that's a great thing there too that you just mentioned, Megan, is be super specific. I think it's important to understand why you're reaching out to that investor specifically, and not just to say that you're reaching out for funding. Make sure that you're not, based in Texas and reaching out to Charlie and he only invests in New York City companies. I'm sure you get a ton of companies that aren't in New York reaching out to you. So it's one of those things where understand who the investor is, and, don't be a B2C company reaching out to Mr. Kapur either. You know what I mean? So, yeah, I absolutely love this. We're going to be doing a lot of stuff. I definitely want to, keep in touch with all of you. There's a lot of things that we're doing through our pitch competition, and we're going to be trying to introduce a lot of founders and startups coming through our network as well to other investors. So we'll definitely, keep you all in the loop with all of that, and, help introduce you to some, interesting startups that would be right up your alley. But for everyone who stuck around, thanks so much. I dropped in a couple other links. If there's anything that we can help you with, let us know. I dropped in our number too, where we do a ton of giveaways for free tickets, pro memberships. If you don't know what Entrepro is, you get access to all of our events for free, plus $20,000 in deals and discounts with partners like Brex. Shout out to Brex, TopTal, G Suite, Freshworks, a ton of cool companies, and just really appreciate all of you for sharing your advice for the founders in our network. And if there's anything else that we can do, just let us know. Feel free to reach out. And yeah, this was great.